So I got to come on from Paco. Thank you for getting us on here. So we're on here ready to start. Right now we're kind of looking at a bunch of stuff today, and something that I found kind of interesting was the sectors, and so there was a chart shared by another person on social media today, and I thought this was kind of interesting. It's something that most people don't know. So it was a 3-year chart showing the technology, how technology has been the major outperformer in the last few years. However, most people don't know that energy is actually the major outperformer in the last few years. Whether you're looking at a 4-year time frame or a 3-year time frame, energy is still the outperformer, which is kind of interesting considering energy hasn't gone anywhere since 2022. Basically, it's just kind of chopped around, been in the same zone so for a long period of time. So I thought that was kind of interesting just to start things off. And then something, we're talking about this idea in our Substack, which is the idea of a spread trade here. You basically get into these major periods where you'll see the outperformance in the short end of the curve compared to the long end of the curve. And so basically what I'm saying here is you could buy the short end of the curve, futures traders especially. It's very hard to do this if you were just trying to buy ETFs. You're not going to get that same performance. But if you're buying the futures, or you're able to trade, the options on futures or whatever you're going to do, you would basically be able to buy the short end of the curve and sell the long end of the curve to make money, because the short end of the curve should outperform. Right now, we're still long the short end of the curve. I still just like the idea of just being long the short end of the curve. You could wait for the signals to come in for the longer end, but spread traders, this is a great spread trade idea that not a lot of people are talking about right now. So I've got a couple guests with me today. I've got Alfonso for the first time. So Alfonso, glad to have you here. We've been talking a bunch. He's with All Star Charts, so been seeing a lot of each other lately. And like I saw his presentation in Sonoma, which was awesome, on international stocks. So I wanted to bring him on here today to just kind of go through what he's seeing in the market. You hear Kashop and I talk all the time, but what's going on in the market from Alfonso? What he's seeing and what we should be looking for going forward.
Yeah, well, Jason, thank you for having me. I'm very glad to be here. And right now, for me in the market, the big theme developing is the sector rotation, right? Sector rotation is the life loop of a bull market. It's like fresh air in the market. Then it was needed, right? I'm seeing small caps are like back in the game. They printed their best 5-day streak since 2020, not only on an absolute basis, but on a relative basis too. Historic moves. We call these moves initiation thrust that tend to happen on inflection points or the beginning of new trends. So for me, that's like the big theme developing right now. Healthy rotation, mega cap technology, and growth stocks halting some of the advance. At illogical levels, I bring some charts. We can go through them in a couple of minutes, but I think that's the most interesting thing in the market right now.
No, I agree with that. It's kind of it's been a long time coming, right? I think the situation we've continued to see in this market where it's like, okay, cool, another tech run, another tech run, another tech run. At some point, it's like, okay, when is breadth going to widen out, or when is the market going to crash? Because really, like, there's two things that happen in that type of environment, and those type of environments, I always say it's really important to watch the leaders. Like if you're seeing 7 stocks go up, pay attention to those 7 stocks because they're driving the entire market up. They could also drive it down. And now seeing breadth kind of widening out into these other areas, I think the hard thing, and Kashop and I have talked about this before, which is the S&P 500, some of these sectors, like the other day, I remember looking at the sectors and going like, wow, most of the sectors I'm trading are up today. However, the market was down heavily. And something Kashop and I have talked about over the years is because technology, consumer discretionary, some of these sectors have become so large in the S&P 500. how exactly can the market sustain its way up if let's say technology is really in a downtrend, which it isn't yet, but let's say it's really in a downtrend. How could the market really sustain itself? So this is an interesting discussion. So I know you brought some charts too, so let's hop into them.
Yeah, let's do it. Um, yeah, well, the first chart, it's the pun I made before. This is the Russell 2000, made an incredible 5 day streak, rising over 10% on an absolute basis. And it tends to happen near the bottoms or at the beginning of new uptrends. As you can see, it happened in the great financial crisis lows, in 2020, in 2011 lows, when Trump was elected president. That was initiation thrust, and at the COVID lows around that. And now we have it here. For me, it's more, like fresh air, as you said, like a healthy pause in this mega cap growth in names, and it is the turn and the opportunity for the laggards or the smaller names to catch up, and that's what is going on. That's what I think. These corrections in, for example, the S&P or the Nasdaq or XLK semiconductors, it's totally normal. I think so far it's healthy for them to digest some gains. I can see like a period of maybe like sideways actions for the next couple of weeks and even months. Um, and that's what my head is at. The next chart is
Sorry, can we go back? I just have a comment that I would like to make on the small cap chart. So I really like how you have added new leg up with a question mark, because whenever I see charts, especially technicians who are not professionals, all they tend to do is extrapolate and say, if this happens, then this is going to happen, and you come up with a prediction. And I love how you have just added that question mark there. And I think that question mark is really relevant at this point, because your next chart, I think, talks into this a little bit. So what's been happening is you have been seeing this big divergence between the the large cap indices, whether it's Nasdaq, whether it's the S&P, and the Russell. So you have had this period where the performance gap between the two indices has just gone completely out of proportion, completely out of the historical trends. And now what you're seeing with this move up in the Russell is sort of a mean reversion. So does this mean that when the mean reversion is over, the shift just starts to go nowhere without really starting a new trend? Or does this mean that once that mean reversion is over, we get the start of a new trend? It's really not something that we can tell right now looking at the data. So I like how you have that question mark over there, because I think that captures my thinking on this perfectly as well. That we just don't know what's going to happen when you see this mean reversion kind of start to close out. So yeah, over to you again.
Yeah, no, for sure. I mean, we don't know what is going to happen in the future, of course, but the data suggests that in the intermediate and long term, this kind of momentum thrust tends to lead on a new leg higher. Maybe in the short term, it can get a little bit messy, and see maybe some weakness in the very short term. But at the long run, I think it is a positive signal for the stock market. The next chart, as I mentioned before, not only happening in absolute terms, but on a relative terms. This is the Russell 2000 relative to the technology sectors, printing its highest reading history of a 5 day rate of change. Looking where this momentum thrust is happening, right at the 2000 lows. So again, inflection points at the beginning of new uptrends. So I think this rotation is going to be like real. I mean, despite most of the people don't believe small caps can lead and technology will slow down a little bit. I believe so. I believe that will happen, and we will seeing it right now.
No, I like this, and I think what's important and what both of you guys said earlier is the fact that we don't know the future. However, when we look at this type of a reading, it's usually significant for certain reasons, and one of those reasons is it usually leads to a move higher, but it's the outperformance in the other sectors or the breadth widening going forward, which is important. I think an interesting one is if you go back to 2000, because I'll just use that one because a lot of people can think about it, and not that we saw the same type of long-term major outperformance that happened for a long time in history, but as a trader, 2020 in November was very significant. We had this big spike happen in small caps, which you can see that kind of show up in the chart, and just that little spike lasted for a year. So I mean, it is significant in some ways, and as traders, we have to trade what's in front of us in the short term. It's long term, sure. I could say, hey, the market has a lot of reasons why I would say in the long term, this isn't sustainable forever and ever and ever. However, we're traders, so we have to trade what's in front of us. And looking at what is in front of us, we're seeing a lot of reasons to be more bullish on these sectors that haven't been loved lately. Looking at the KRE is incredibly also like every day I look at that thing and I'm like, I have no idea how this is just shrugging off everything. Like the other day, the whole market's down, everything's down, KRE's green. It shrugged off everything. And granted, it's not none of the names are really in the S&P 500. Some of the names are in the small caps index, but it's shrugging off everything. Even the days the small caps are down. So that's been kind of interesting. Something to keep paying attention to is the idea that these banks will continue to do well. But I think part of that reason is we have to look at the yield curve, what the Fed's doing. And so, most of the time, the first rate cut as well leads to your theory. So the first rate cut usually leads to a bullish outcome. But once we get deeper into those rate cuts, things change. But right now, I'm just seeing kind of that there's blue skies ahead, but there's trouble a lot further out. But once again, I can't trade what's way further out. I have to trade I'm basically trading to the end of the year. That's the goal. So what are we saying to year end? And I think you're illustrating that beautifully.
Oh, thanks. And back to the bank conversation that you mentioned. Large cap financials. I mean, on a large cap basis, financials are now like the best performing sector on a year to date. So that's huge, right? So not only large cap mid cap financials are doing making new 52 highs, small caps too, leading by the regional banks. And I think those are the areas that will keep leading towards the end of the year, at least towards November, I think.
No, agreed.
Not just the financials, the private equity names, the listed stocks, they have all seemed to have gone vertical in the last week, like BlackRock, Blackstone, that entire sector. It's very surprising to see. But that's one really good indicator that this is not a recessionary environment, because if it's a recessionary environment, then you just will not see this kind of performance in the financials or anything related to the interest rate environment. So that's a good sign. So at best, it looks like what we are seeing is a rotation, which is quite healthy and not exactly recessionary. Even though if you look at the commodities, it kind of feels a little recessionary, but that could just be because we had a lot of euphoria in commodities. Like I've been in the commodity sector throughout my trading career, and I never seen that level of broad bullishness towards an asset class like we saw from the March to May period. So it's perfectly healthy for commodities to be working off that excess in sentiment and looking at financials, looking at commodities, looking at rates, bond futures. Everything kind of points to what Jason was saying about blue skies ahead, but potential trouble down the road. But until you get to that point down the road, you don't really know what kind of trouble that's going to be. So just forge ahead for now.
Well said. So the next chart here, large cap financials, mid cap financials, small cap financials, all 52-week highs. So what are you seeing here, Alfonso?
Well, I think the next chart tells a good the story of what is going on with financials. Here's a big six bank index. This is an equally weighted chart about taking JP Morgan, Goldman Sachs, Bank of America, Wells Fargo, Citi, and Morgan Stanley. They have been leading the way up, but now mid caps and smaller banks are catching higher, like confirming the strength within the sector. Also, like overseas, financials have been doing great. For example, in Europe, in Japan, some banks over there are doing great. So I think this is a strong sector right now, and a good spot to be in.
No, I agree. Look, it's everybody continues to always go back to the banks, and the banks are incredibly hated. And I think that's something because most of us who are trading grew up at some sort of point where we saw 2008 happen. And so every time anything happens at the banks, you see a little bit of weakness. Everybody kind of goes, okay, that's the end of the banks. I think it was very ballsy for a lot of people to take positions in the banks this last time, and it's paid off. And most of the time, when you have that type of sentiment, that hated sentiment, where people are going, okay, the market's kind of in trouble, and this is going to happen, and most likely the banks are going to do this. However, you also have the yield curve coming out of inversion and so on. It's probably going to be a good environment for the bank stocks.
Yeah, no, I completely agree. And if you look at this chart, look, it's reclaiming the former high from 2021, 2020, and the great financial crisis highs. So, this trend may be entering like a new like higher and a secular bull run for banks. So I really like it. I really like this space.
Nice. So what do you got next up here?
I would like to show you this. It's more about the same topic. This kind of rotation is happening in most of these indexes in logical levels. At the end of the day, this is the 161 extension from the S&P. Look at the price. Hit this level. It is halting its advance. It's correcting a little bit. The same for the Nasdaq 100. It kissed this extension. It's correcting right now. Here is technology hitting another extension level. This is a zoom out chart, but again, these extensions are coming into play in these heavy tech and mega cap indexes, sectors, and industry groups. This is an interesting chart too, because again, not only on an absolute basis, but on a relative basis. Here's technology relative to the S&P 500. Hitting that overhead supply from the dot-com bubble highs, right? So if there is a logical place for technology to just take a breath from the recent trends and from the recent leadership, I think this is a logical place to do it.
No, I agree, and I love looking at these relative charts because when you kind of see these, a lot of things make sense, right? People look at these sometimes and they go, okay, why is there price memory at these levels? It's an intermarket chart. However, sometimes it's a psychological price level that people don't know about, and it's based on value. Do you think that? And I had an uncle who always talked about the idea of relative value, and not as in value investing. Like, do you think, for example, coming out of, and this is actually super interesting now that I'm thinking about it, coming out of the technology bubble, the things that really ran, small caps, micro caps. Micro cap stocks made a huge run at that time. Same with gold miners. So it's kind of interesting to kind of look down the road and kind of go, okay, what type of recession do we have? Like, let's say we did have like a point where we were like, okay, we actually are heading into a recession. Let's say tech stocks crash. I don't think that. I don't believe that at all. But let's just say it's like 2000. A lot of people don't know that the commodities started to bottom right at that point. A lot of the commodity stocks started to bottom right at that point in 2000, right around 2000 to 2001. The gold miners ran right through that whole those 3 years that we were in recession and that the Nasdaq was going down. Gold miners started to go up. So it's like, what type of environment do we have sometimes? And that's why I think it's always important to understand that if you're a macro trader and you're looking at all these different sectors, you can always find some place where you want to be. But just looking at the market and going, okay, well, tech is going down, therefore I can't own anything. That's not the way to look at it. I think it's just, let's look at it in a sense that there's other areas to possibly look to right now, and some are very interesting and some don't look as good as others, and that's just kind of the nature of a bull market, like you said at the beginning.
Yeah, and it's not like the first time technology it's like in a pause, right, and not like leading the way. For example, very recently in 2022, when the market bottomed, a lot of areas were working except of technology. Technology was a laggard for a few couple of months, and then catch up higher and took a leadership role, right? So it's part of that rotation that it happens in all cycles at the end of the day. And as you said before, I mean, there will always be like different opportunities depending on the environment, as you mentioned before. So I think this case is this cycle is not different. I'm not telling I'm not telling that technology is going to crash or is going to correct, but maybe it won't lead higher, right? It won't outperform, maybe. That's what is going on in the last few 3-4 weeks. So let's see if this steady outperform from some value oriented groups and small caps and micro caps stay for longer, right?
So
No, and that's
there's
interesting. Go ahead,
there's
Kishore.
one similarity between the .com and the current cycle, and there's one difference. So the .com cycle, you had Cisco was the leader, but at the same time, most of the stocks that were going up in the tech space, they were all software stocks. And this time, the leaders are not exactly the software stocks. By software, I mean the application software. And the leaders instead are all the hardware stocks, the semiconductors, and you have, of course, the platform stocks like Apple and Microsoft. So that's one big difference. And the second difference, if you look at it, it's in terms of the magnitude of the move. So you had the long-term capital management implosion in 98, and then you had the Fed, everyone just kind of bailing it out. And after that, you had a good 2-year run in tech. That was the dot-com bubble. That was the blow off top. And this time, it kind of started with the Fed's bailout of Silicon Valley Bank. But if you look at the magnitude of the move, it's not as great as it was during the dot-com bubble. And at the same time, it hasn't really run as long, although you can say the valuations got kind of as insane as it did back then. And the other difference is, so when the dot-com bubble burst, tech entered a brutal bear market because it was just collapsed expectations. And commodities did very well because China joined the World Trade Organization in 2001. So they got rid of all the tariffs, they made the market more open, and they started importing a ton of commodities because they became the manufacturing hub for the world. And if you look at, I'm not very, I don't follow US politics all that well, so let me put that disclaimer. But if Trump wins, given his pick for his running mate and given everything that we know about him, chances are industrials are going to make a big comeback in the US. So you might see a point where the US becomes a leader in manufacturing in industrial. So whatever happened post the dot-com bust with China, where all the manufacturing moved there, you might see the exact reverse happening. So it's kind of like the yin and yang where history just inverts. So I think that was just something that struck me when I was looking at this and drawing that historical comparison. And if that happens, then the next time you're going to do a comparison of all the sectors in the S&P and how they are performing, you might very well see instead of energy, you might see industrials on top. You might see utilities second, something that I think we haven't seen in our living memory, where these are the sectors that are leading. And it would just be an interesting 10 years, 20 years, if as a market historian, when you look back and say, that was the moment where everything changed. Just like now you can look back and say, the creation of China joining the WTO was the moment where the world trade changed.
That's really fascinating. And once again, it's when you're looking at markets, it's always this thing where everybody wants to put it into this perfect box, and it's like, no, it's exactly what you said. You find the similarities and then you find the differences and try to find something in between. So great, well said there. So Alfonso, do you have any more charts for us?
I mean, I bring a lot of charts. I don't know what topics do you want to cover.
Anything. I'm happy to go through exactly what you have, because like you said, rotation, anything that you have, and anybody out there, if you guys have requests, please put it in the
And I
chat.
have a question because I don't cover commodities, right? It's not my area of expertise. But how do you see right now commodities? I know gold has been doing great lately. Made a little bit of a failed breakout the other day. It's now in a range within an ongoing uptrend. But what are you seeing out there with gold, silver, copper? What are your thoughts over there?
So for me, with precious metals, we'll just talk about precious metals alone,
Yeah,
right?
exactly.
So precious metals alone are, I think too many people get into the like, oh my God, it came down a bit. And it's like, if you've been a commodities trader for a while, you know that these moves are like completely normal, especially looking at like where gold's at. Gold goes up, it comes right, it breaks out a little bit, it comes back into the range. Kashop, how many times have we seen golds break out and go back into a range? Like it happens like every other day. So, you kind of have to look at it. One is maybe that complete safe haven trade is taking a break for a minute because, and I still think that that's still possible. One, gold loves this type of an environment. I had a chart, maybe I could find it, but gold loves the type of environment where you kind of look at it and go, okay, well, if I'm coming out of this inversion, then it probably does move gold higher. Most of the time, that inversion, when you start to come out of that inversion or that point of inversion, is kind of when gold starts to get its mojo going, so to say. I don't know a better way to say that, but gold starts to move. So I have a chart here, so I'll bring it up in a sec. Nice. So when we're looking at this chart, you look at the points where the Fed is kind of their rates are kind of flat. They're going to neutral, and then they start to cut. And the same with the yield curve. You see the yield curve is inverted, and then through the cuts, it starts to come out of inversion. Coming out of inversion is usually when gold makes its runs. Gold starts to make a really nice run out of each of these inversions over and over and over again. So I would say, you really have to pay attention here to the fact that we did, and the green line, it's from a while ago because that's when I put the chart out. So forgive me for, not drawing that a little bit better. But basically, we're able to kind of see, okay, gold is at a point where it's gaining energy and momentum. And then once it starts to gain that energy and we start to see breakouts in it, then I start to go, okay, well, now we're seeing 52-week highs. Now we're seeing 100-day highs. I don't have any reason to think gold will come down here. I do think that gold can consolidate and chop around and frustrate people a lot longer than most people think. So I do think it's a very simple one right now, which is wait for those positions to happen. Wait for that time when you're going to see a clear break one way or the other. I have another chart here where gold of course, I ran out of charts. I always do that. But gold comes back into consolidation, moves sideways, and I'd really just wait for those breakouts here. I'd wait for a breakout or a breakdown. If you're a short-term trader, you could trade that breakdown. Let's say it does break down, you trade it back to that 2100 zone or something like that. But if it doesn't really break down, it kind of holds these levels. Now, this is an old chart. This isn't from that the move down from yesterday, but we didn't break down those levels yet. So kind of looking at it and going, okay, if it breaks down, I'd get out of my position at being long for a swing trade. If it breaks out, I would still take a new position thinking this could go a lot higher. And the other thing about gold, Kishab could speak about this a bit more, probably more eloquently than me, but looking at going to gold stores lately and talking to people in gold stores, there's nobody's panicking, nobody's panic buying, nobody cares yet. like gold is at all-time highs, and like the times I've been in gold for years. It's almost 20 years of being a buyer. And being a buyer for 20 years and going into these stores and seeing what happened in 08, 09 and 2010, like seeing the mania and seeing that we're nowhere near any of it. That makes me really bullish on gold to continue to possibly move higher. But once again, we got to respect the price action first off. But I would say higher. I'd be surprised if we just started breaking down. Silver, though, it has to start to show up as well.
I was about to ask you about silver. It hasn't been like confirming the new highs in gold. So what is your take on silver? Ideally, should outperform. Ideally, should trade along with gold, or just like trade what is in front of you, focus on gold or focus on silver, and ignore that like correlation and confirmation between the two, right? How do you see it?
I like to look at the outperformance. Like I like to see that it's outperforming, and it was for a while, right? And even the miners were outperforming for a while, so it's not uncommon to see the pullback that we're seeing in silver. So if we think about it this way, if you see a 2% pullback in gold, you could see a 8% pullback in silver. That's pretty normal for silver. So like you did see this big drawdown in gold and silver being outperforming to the downside, but also you have to think about silver can also outperform to the upside. So also kicking it over to Kashab, Kashab could talk about the miners. So Kashab, what are you seeing in the mining sector? I saw we did hit a new high for a second the other day. I don't know if we retook it, but what are you seeing in the mining sector?
The mining sector, so if you look at gold and then you look at the miners, it's like they're completely two different worlds. I mean, sure, you're seeing the GDXJ, finally they are starting to hit 52-week highs. But if you drill into the individual stocks and you look at their performance in the longer time frame, just starting from 2020, they haven't done all that great. And that's just because the 2022 bear market was extremely brutal and valuations still haven't caught up. And then you also had this issue where some of these miners, they gamed the system, meaning they became bigger by acquiring their competitors just because they wanted to have a bigger weight in the GDX. Because as we all know, everything these days is about passive flows. And if you have a higher allocation in the index, you are really going to benefit. So all these miners, what they did was they acquired, got bigger, and then the 2022 down cycle hit. A lot of those assets became worth far less than what they paid for them, and the mining stockholders are still paying that price. So that's why you see gold hitting new highs. And if you look at a lot of the single asset miners or a lot of the quality stocks which didn't grow, which didn't game the index, if you look at those stocks, they have been on an absolute tear. So, in fact, just recently, I was compiling a list of stocks to see whether they had outperformed Bitcoin this year. And going down my list, like about half the stocks in the gold mining index, they have outperformed Bitcoin. And the other half, which is the composition of your indices, they have kind of lagged behind the ones that have not grown in terms of inorganic growth, that is acquisitions. So you have these two different worlds. And then coming to the juniors, these are the companies which don't have an operating mind, meaning they have no cash flow. So all they have is a deposit or a construction project or a development stage asset that they are looking to shop around to buyers. They have had it even more brutal because for those stocks, what you really need is not just the gold price going higher. You need the funding environment to get looser because these are higher risk companies, high risk, high reward stories, and they only get love when the market is just throwing money at projects. So, like what we saw with the startup craze with AI, where you just have an idea, you pitch it to a VC, and you get $1 million check. The funding environment for these gold development stage assets or the exploration stage assets has been the opposite. So there was a point last year where the volume on the TSX Venture Exchange, which is where all these companies list and raise money, the trading volume was at abysmal lows, something like a 20-year low or a 30-year low. And then you had this big gold mining conference in Denver where the CEO of the number two gold mining company was speaking, and there were like just two people in the audience. So you had that lower level of interest in the entire space. And so coming off a huge sentiment bottom, coming off a huge uh, tough funding environment, you have seen these stocks pick up. But just because these stocks look like they are making 52-week highs doesn't mean that they are overvalued. In fact, it just means that the market is only now slowly starting to reprice these stocks as growth stocks for a higher gold price environment. So that's what I look at when I see the mining stocks, which is why I'm very bullish on the junior miners. Because now with the Fed cutting, you're going to see the funding environment get better. You're going to see gold outperform. And once capital rotates out of tech into the other sectors, you're going to see investors cutting larger checks to these companies, which means they can have their own growth story. So the growth stories we have seen so far have all been AI related or data center related or along those lines. Whereas when we get a true commodity cycle, the growth stories that you will see will be in these names. So anyone going back to the bull market in gold from 2002 to 2006, gold was up every single year. You couldn't have had a more environment with lower volatility and good returns. And these stocks were absolutely on fire because that was just the perfect funding environment. And that was also the time where the world was globalizing. So you can go hunt for exotic deposits in Tanzania or Kenya or Namibia or just name any country, Venezuela, and people would just throw money at you. It was a glorious time. And we need a commodity bull market to come back to get to those times. Now, I'm not saying we will get to those times, but if you take the so if you just pull up the gold chart, the GDX chart, and just look at the daily chart. I mean, so you're a CMT and Jason, you're kind of there too, even though you don't have the designation. But if you look at something making new highs, your instinct is to buy. Whereas a normal person looking at something making new highs, they will be like, oh, I missed it. I'm just going to catch it on the dips, or I'm going to buy once it starts crashing because it will go up again, or something like that. And so what will happen is they will miss out on this run. But the fundamentals, what I'm seeing as the fundamentals tells me that that is not at all the way to read these charts. That this is just the start of an uptrend coming out of a long bear market come difficult situation for the miners. And on gold itself, so one thing I would add is gold and real rates, that relationship is documented. In fact, you kind of showed that with gold and yields. The other relationship, so I'm not sure why this relationship holds because fundamentally it shouldn't, but traders tend to buy gold and the Japanese yen together because they consider them both as safe havens. And given what's happening with the yen recently, it's kind of acceptable that gold has a bigger pullback because that relationship is broken. And when those correlations break, you don't know how those models and those factors will adjust. So I would be totally comfortable if gold pulls back to even 2200 and I would still be long. I wouldn't panic. I wouldn't call the end of the trend just because of what we are seeing with Japanese yen and the real rates and the fundamentals that I just been talking about with respect to the miners.
No, that makes sense. Nice. So, Fonzo, what do you have going up next? I saw you going through some charts, so we talked about
Yeah,
GDX. So GDX
yeah,
against.
more of that conversation about the miners. I think I found this chart very interesting. GDX gold miners relative to the S&P put on a failed breakdown. Now this ratio is back above that shell of former lows. You know, I mean, if gold miners want and need to outperform, I think this is a logical place to do it, as they did in 2015, 2016, 2018, in 2022. So I think this chart it's very interesting.
No, I love these ratio charts because and gold GDX, man, it's I really think just like Kashop's thinking, most people they look at things and they go, I missed it, and I missed it. But there's the other part of it that we didn't talk about yet, because at some point, if you really like something, you'll chase it. They will absolutely get in at the wrong time usually, and it's
That's
not. And the thing is that for right now, that makes a lot of sense. And what Kashop said is, this would probably be the right time. You know, like 52-week highs, 100-day highs, 200-day highs. These are usually the right times, but the wrong times are usually when like there is the mania and everybody is buying and everybody's at the stores and the stores are flooded. So this is
that's why the point you made early about that sentiment, I think, made me a little bit like more bullish at the end of the day. You know,
yeah.
I really like that one.
It's important to take all that into context, because it's when you're kind of sitting there and you're looking at these charts and you're going, okay, well, the ratio chart even is in a downtrend. But I think the most important signal, and one of my favorite signals, and everybody hears me talk about this way too much, which is the false breakdown signal.
Yeah,
false breakdowns, they happen a lot, and there's a lot of money to usually be made in those types of signals.
As JC and Estrasa said, and that's one thing I have learned from them working at Ulster Chart, is that from failed moves come fast moves in the opposite direction. So let's see if this time that happens. But I mean, gold near to new all-time highs and new uptrend underway. Gold miners might outperform from these levels, but I mean, for the people that don't trade futures, what like equity vehicles can they use? And for me, I think I really like this chart. I really like WPM, because I mean, on Twitter the other day, some people told me that, hey, this is a silver miner. It's more like a silver vehicle, but actually it looks more like gold. So I take WPM like one of the best vehicle to express like a bullish thesis in gold.
That's interesting, because I actually do like that one as well. It's one that I do own, but I've always wondered what's Kashop's thoughts on because Kashop knows the actual fundamentals. Sometimes I'll be buying things well, over the years his opinions have changed a little bit, because I used to buy things and he'd be like, dude, that's the biggest piece of shit in the world. and like now it's kind of like sometimes you want to own the junk. Even so, I'm wondering. I know this is a silver miner. Kashop has talked about it in the past. So, what are you thinking about wheat and precious metals at the moment?
So I've been long since the $40 range, and this is a stock that goes into the long-term portfolio, meaning you have very little volatility, you have good dividends, and it's a well-managed company that's probably going to be around for the next 10, 20 years. Now, you look at most miners, you can't really say that. And the difference there is the founding team and the business model. So, Wheaton Precious Metals was founded as Silver Wheaton. So, what they did was they had a streaming interest on mining properties. So, if you are a copper miner and you're trying to develop a copper mine and you need funding, you can raise equity, you can raise debt, or you can raise something like a silver stream or a royalty. So what this does is most mines aren't just pure single metal mines. So a copper mine would have copper gold or copper zinc or a combination of all the metals. So if your primary product is copper, what you can do is you can sell all your silver to a Wheaton Precious Metals, and in return, you would get an upfront financing. So the way it would work is you contract to sell all the silver that you produce at $4 an ounce, and in return for that, Silver Wheaton gives you like $100 million upfront. So you can use that to fund your capex without diluting shareholders, without putting too much debt on the books. And Silver Wheaton benefits because the silver price goes to 20, 25, they are buying at 4, they are selling at 25. So whatever money they have put in upfront, they get that back. It's similar to the leasing model, except you have much more upside because mines tend to go on for 30, 40, 50 years. In fact, there are mines that are even producing for 100 plus years. So somewhere along the previous bull cycle, I forget exactly when, Silver Wheaton, they changed their name to Wheaton Precious Metals because they started doing streaming deals on gold and cobalt, and they just expanded their portfolio. And at that point they said, we don't even get 50% of our revenue from silver anymore, so we're just going to make it wheat and precious metals. And if you look at this stock, it's just been a standout winner. And the best part is it's very little volatility. So COVID crash, I think, is an exception because every stock had that pullback during COVID. But other than that, it's just a beautiful chart to look at. And that's what makes it safe. And there are a couple of other companies which are doing similar things in the precious metal space. So you have Franco Nevada and you have Royal Gold, which do royalty deals instead of streaming deals, meaning they give the mining company money upfront. And instead of having to pay ongoing like $4 an ounce for silver, they can just whatever gold is produced, they just get 1 or 2% of that for free as an on a no cost basis. So that way, it's just like how if you live in the US and you're in one of the Texas or one of these countries where you have a mining rights to the land that you own and you give it to a developer, to an oil producer, and you get a free royalty on whatever oil is produced on the property. It's a similar concept, except they do it with gold mines, copper mines. So these are the companies that you can kind of hold it for the long term, knowing that nothing really bad is going to happen. And Silver Wheaton fits that bill because they practically invented this business model. So Silver Wheaton, Wheaton Precious Metals, they invented this business model. So I really like the stock, and I can see myself owning it for until the commodity bull market ends. Because at that point, I would just be out of commodities completely.
No,
Nice.
that's good. That like Kashap has entirely so much info on some of these things, so it's cool. Everybody kind of got a lesson, and this is how you look at a gold mining stock, kind of value it, and then also like understand like there's plenty of things that have value, but they're not in uptrends. This isn't an uptrend. This is breaking out. The chart actually looks fantastic. You know, and when you add all those things in, now you have a great trade. So that's great. So Alfonso, what do you got next?
I don't know if you want to talk international equities, maybe.
Yeah, love to do that.
So, I mean, international equities, Europe have been doing well for this year. I remember Jason, in my presentation in Sonoma, like everything was like breaking out, right, to make new highs. Well, since then, some indexes have retraced, are consolidating. Some of them are consolidating in tight range above the breakup levels. Some of them are failing to hold those levels. So I bring some examples that I consider very important in the world. Here is the United Kingdom, consolidating above the prior cycle highs. Here is Spain, similar story. Here's Denmark, not even close to the breakout level. It looking a little bit much better, but still like consolidating after breaking out. For example, Japan in Asia, that's a monster base. I think good opportunities are coming from Japan as long as the ETFs EWJ remains above 66. That's my line in the sand. That's represent a former cycle highs. So that's an interesting and a big level for Japan. Asia, we're starting to see some bearish to bullish reversal trends trying to resolve higher. It has taken time for some of them. Some of them are failing. Here's Malaysia. It's right there at the upper bounds of that reversal base. If it reclaims 2350, I think a trend reversal will be valid in Malaysia. Here's South Korea. It tried to break out. It looked very good, but it failed to break out. It needs more time to consolidate and build up like the energy to break out. In Latin America, Argentina looks great. Argentinian ETFs looks great. Strong uptrend, consolidating above the 161% extension. I think as long as ARGT remains above the 5350 level, I think this uptrend is still intact. And the last one is Peru in Latin America. That's a monster bait, has been carving out. I'm waiting for a decisive break at above 45. And I think that will happen in an environment where copper breaks out too. It will be like they will try to trade together. So that's what my head is at on an international equities.
No, I love these charts because it's I always love, and this is the thing that I think not enough people do. Like, there's so many sectors, there's so many countries, there's all of these different things that you can look at, trade, and so on. And people get stuck in and I think it's a thing, especially in the United States. In the United States, everybody thinks the world revolves around them, and that's about it. However, there's all these different areas to invest in, all these different areas that make money. I remember what was it, 2019, and I was long Russia, and I was long Brazil, and those massively outperformed, and Greece. I think it was Greece too, and those massively outperformed the United States that year. And most of the time, people don't believe things like that in the United States. They're like, oh no, you just invest in the S&P 500, you make all the money in the world. And yes, most of the years that's very right. However, there's been long periods of time where other countries have outperformed, and not to mention some of the stocks you guys love are in these other countries. You guys love Alibaba and all these different, and Tencent and all these different things. That's China. So figure out what's inside of these things. You like banks? Probably go find a country that most of their stocks are in financials, like Greece. Do that over and over again, and you're going to find major areas to either find stocks inside of that other people aren't talking about that could massively outperform the market, or you can find a country that you want to invest in that's showing relative strength when the United States is not showing it. And especially right now, I think it's really important to look at these things if we're going to take this bull market like we're all talking about, this rotational bull market. What if tech tech isn't leading the way as a huge component of the S&P 500? So where do you put your money? Well, you probably want to look at other sectors and possibly other countries and other asset classes even. So lots of interesting things here. And, thanks so much for coming on, Alfonso. So where can people find you, find your stuff on Twitter, find your work?
Well, first of all, that was a great explanation. I agree with what you said. And maybe, international equities or different sectors in industry groups, they also work for information purposes, right? For risk appetite information at the end of the day. If these countries are participating higher, it expects risk-seeking behavior overall in the entire world. But Jason, very happy to be on your show. Thank you very much. It was a pleasure for me. You can find me, on Twitter at AlfCharts. and I'm very glad to join you today.
Yeah, no, thanks for coming on, and this was a lot of fun. It was to me it was really cool to have a show where we kind of got to talk the technicals. You kind of go through all of these amazing charts, and then Kashab kind of come in with his views on the fundamental side of these things. So I thought the show flowed really well today. I hope everybody enjoyed it. Make sure to follow the speakers, ALF Charts. I think it's ALF Charts, right?
Yeah, correct.
And then follow Kashab. Shop's name's right on there. All right, guys, we'll see you next week at 11 a.m. on Fridays, Eastern time. And then on Mondays, we have the commodity report at 11 a.m. Eastern time as well.